are you guys all doing tonight? So I've got a question for you. Who here, either themselves directly or a friend or joint venture partners, had trouble with financing lately? 1, 2, 3, 4. I'm surprised it's not more, because we look at the numbers and we're seeing that with the new guidelines that have come out with B20, lenders have really tightened up on things. Things like self-employed programs, stated income debt, what you could do 3 years ago just doesn't exist anymore. Just kind of curious to see people actually in the room that are doing deals that they've come across. I'm just going to touch a little bit on the deals that we've done in the last 45 days.
Louder?
Sure. I'll just touch on the deals we've done in the last 45 days and how they're falling product-wise, which types of lenders they're going to, and kind of the timelines. So a little bit about the Green Mortgage Team. We work with clients across Canada. We're investment focused, so the majority of our clients are investors. We funded about 350 mortgages last year, and 60 to 70% of them are investors. So it's our primary focus. As the market changes, rules shift, or strategies adapt for investors, we're there learning with you guys, and we're usually ahead of the curve. A lot of clients come to us and ask what the lending environment is right now. It is stressful. Rules are changing constantly. Things that we could do 3 months ago, we can't do anymore. The problem is when you're in a deal and all of a sudden you find out that it's not doable, it's pretty easy to get caught up. So it's our job to make sure that there's no problems and make sure things move along smoothly. So in the last 45 days, we have 3 main elements of our business. The first one's the investment side in the residential channel. We funded about $11, $12 million in the last 45 days. It's about 60% of our business, so about 29 deals. Average subject removal on that's 3 to 4 days, depending on the market. One of the common strategies clients are doing is flips. It's really picked up in our client base, and I'm sure a lot of you guys are thinking about doing it as well. I'll briefly touch on the strategy of move away from the A lenders for your initial deal, shift towards the private lending. Because what we're doing is with proper conversation and homework, we're able to write subject-free or 6-hour subject removal. Private lending is your worst case. We're still going to shoot for an A lender for you guys. So it means that you're going to get the A-side financing, but we're going to use the quick and easy financing to see can we just get the foot in the door. It's our worst case, but usually on a flip, it's a short holding time. And the main advantage is that we can get in, get a better offer. Maybe you save $10,000, $20,000, $30,000 depending on the purchase price. Then we shoot for the A-side financing. So it's a common strategy. That's the way we've really been able to boost people's ROI on their flips. Taking a deal that maybe will make $30,000 and $300,000 flip, they'll bring it up to 30, 35, 40. When you start doing 6, 7 of those a year, it makes a big difference. On the commercial side, we had 5 deals done in the last 45 days, $28 million in volume roughly, so a couple of big projects and some smaller stuff. We are seeing a lot of investors shifting towards the commercial side because the rules haven't really changed in the last 10 years. So constantly the residential channel is getting kind of choked by the government because that's where the backlash comes. People say we can't afford houses. We're mainly in the Vancouver market. So people are really, it's an uproar. So the flip side is the lenders start adapting to try to make politicians happy because the politicians want to make people happy. So there's been a lot of changes on that aspect. And then on the residential channel, about $11 million, I'm reading the number, about $8 million, 14 deals. Average subject removal is about 2.2 days. So we're pretty quick on that side. Insured stuff's less than 24 hours. So where are people going for financing? On the investor side of the residential channel, most people are still going to the big banks. They're generally the most flexible for getting around net worth requirements, adapting for income, but they don't use the most rent. So there's been a real increase in clients going to credit unions because credit unions will use 80, 90% of the rent on an investment property sometimes. The big banks will usually go up to about 55%. So it can make a big difference if you're someone who's not declaring a huge amount of income or you've got a decent sized portfolio. The other aspect is clients are also shifting towards private, like I said. On the residential side, people are still, it's an even spread. Monoline lenders right now are quite competitive. So if you're doing anything on your own home, I would really recommend talking to a broker because this isn't something you're going to get from RBC. They're not going to tell you there's better options. We're seeing 30 or 40 basis point difference. So on an $800,000 property, it's a very big savings, like $3,000, $4,000 a year. It's just the difference of looking at a different lender. Commercial side spread, as always, credit unions and the big banks are quite competitive. They like that business. Private lenders are still commonly used when you're trying to rent out a property and improve it, which is the main reason why you want a commercial property anyways. When it comes to fixed versus variable, it's about a 65% going in variable from the investment side, but there's 2 categories to that. People doing flips, it's 100%. If someone recommends that you do a flip and fixed product, you should probably get a second opinion. On the owner-occupied stuff, it's about 50-50. Big difference though is variable. The penalties are a lot lower and you have a lot more flexibility. So if you're buying an investment property, you're probably going to time your sale based on the market or a tenancy or some sort of problem or benefit to the property. You're not going to do that on a residential side, so that's why we see more people going on the variable. And then commercial is dead 50-50. It really depends on what you're hoping to do and what your plan is. So the main reasons why things have been tightening up is the B20 guidelines are the newest set, the stress testing we've all heard about. Believe it or not, you'll get better rates putting 5% down on a property than putting 55% down. So your kids buying their first property are going to get better mortgage rate than you refinancing or purchasing a house with 50-60% down. And that's just because in the eyes of the lenders, the 5% down deal is risk-free because the government takes the fall if there's an issue. There's a lot of public pressure. I'm sure you guys have seen in the newspapers that realtors are the bad guys and that everything could just be cured if we lowered prices. So the problem is, how do we do that? And that's something that the lenders, basically they're caught in the middle, and it's just they have to tighten up, tighten up, tighten up. Basically the end of the little section. If you guys want to chat a little more, happy to chat. I prefer to sit down one-on-one and kind of go more in depth. That's kind of where we shine a little bit. My contact details are there if you want to reach out, and I think James or someone will take over from here.